Hey there, and good afternoon, everyone. Trader Tim from eMiniMind.com. Going to do a Monday market analysis slash technical trade recap for the week. We've got a lot going on in the market. It's going to be a shortened trading week this week with Thursday closed and then Friday a half day. But there's a few things I wanted to talk about from last week that I didn't get to talk about on Thursday. So we'll do a kind of a combination looking forward and go through some trades as well. Now I wanted to start here on the E-mini S&P, and it's getting a little bit clearer the sideways price action that we're seeing. We had the nice trend line drawn up. We touched the trend line, we bounced a little bit, we touched it again, and then we broke down below it, came back up to it, and then last week on Wednesday, we really broke down below it. And then we were able to rally and close above the 50%, which is a very strong sign for the bulls. And one of the things we've been talking about in these last couple weeks is, even though we've had these mornings where we've had big selling, so to speak, we've been met with buying right after that and closing up on the day, closing with these hammer formations and closing back into, positive or break even territory on the day. So even though we're consolidating, sort of moving sideways atop this negative 61.8, which is the negative 61.8 from way down here at 2420s, that 50% retracement on the daily chart. Lots of good things are sort of brewing, if you will. If we draw from highs to lows, we can see that we've broken the short, and thus drawing from lows to highs gives us a 50% long right about 25.7250s, and that's just a touch bit lower than this gap up from Thursday. And so if we were to dip down, we've got the big body candle, the gap up, inside day, inside day. So tomorrow we should either see a breakout to the upside, a breakdown, at which point, are we going to break down and then trade back into this big body candles range, or maybe one more day of consolidation. We have existing home sales tomorrow, and then durable goods, jobless claims on Wednesday, as well as the FOMC minutes. And then Friday is just a shortened day, so not going to be trading on Friday. Thursday, the markets are closed. Typically, the Wednesday before Thanksgiving is always an up day. Now, I should never say always as it comes to the markets, but um, I'd say 95% of the time, the Thursday before closes up. And so, going into the week, we've got the potential for some break into new highs here. We're very close. But what I wanted to talk about and kind of compare is how these inside days look compared to the breakout trending days. And if we come over to my tick chart on the right, I've just got a 512 tick chart set up with the Heikin-Ashi candlestick on top of that. And you can see today, very just by quickly looking at the chart, you kind of say, that looks pretty messy. Now let's go back to Friday, also an inside day. Same kind of thing. Well, that's pretty messy. We just by looking at the breadth of the market, mostly sideways. We can see a couple little trends in here, but on the whole, messy. And then as we come over to Thursday, we can see, wow, okay, there's some structure to the market. There's some nice trending, and just by having a very simple chart setup, very simple trading screen, it can be really helpful to be able to depict, well, are we going to a trending day or is it going to be a choppy day and a range bound day? And so I always start with, well, are we inside the previous day's range? Or in this case, inside the gap up, the big body candles range? And the answer to that for the last 2 days has been yes. And then, are we within the first 30-minute range or the first hour's range? Did the market open up for the day and then just sort of stay there? Or is it actually moving? Because, any trending day is going to start with an opening range, but typically those trending days move away from that opening range fairly quickly because, in other words, it's trending. Well, a consolidation day or an inside day, choppy day, is typically going to stay within that first 30 or first hour minute range for most of the day. One other thing I wanted to talk about from Thursday that you can see, just very clearly as the market started on its way for the day, we can see these swing lows and swing highs beginning to form and easily grab a swing low to a swing high, see the market pull back to the 50% and then, break out once again. And the market doesn't always make it back to the 50%, as you can see here, but when you get in one setup, when you can get in at 150%, using a trail stop to trail the swing lows on the way up is a great way to take advantage of a running or a trending market. And that's something we talk a lot about in the trading room each week. You can check that out at emonymine.com/VIP to sit in and watch me trade and jump in and ask questions and things like that. The other thing I wanted to touch on from Thursday, we get these situations where we're moving higher and then okay that we traded at a 50%, then the next low to high, well that one didn't pull back into its 50% retracement. We kind of rallied a little bit and then moved sideways before kind of taking a breather. We can see, okay, up at highs we got this little double top. We can draw from highs to lows, and we have a short setup that does set up and move down through its negative 23 all the way to its negative 61.8, and then we've got another start of another rally. Well, when we draw a bigger setup, such as if we're coming back, let's say the market's pulling back here and we're not sure if the market's going to stop at this larger 50% retracement, we can just let the market trade that, not meaning we're not just taking a blind limit when it's a bigger setup like this. Let the market trade at the 50%. And then just kind of zoom in here, we can see we got this nice little double bottom. We came up and we broke this little swing high, and we can just draw from lows to highs. The first setup after that little bit larger setup occurred. So I would call this larger one, the 15 minute. If we just take a glance at the time, that two anchor points, 8:30 till a little after 9 o'clock, and then the setup occurred at about 9:30. So, if we were looking at a 15-minute chart, this would be a pretty clear, a bigger setup. So when we get onto the 512 tick chart, we can let that bigger setup trade, just wait patiently, let it trade, and then zoom in here. And then we can see, okay, well, we got a double bottom, and then this high broke the previous swing high, and we can just grab from lows to highs, let the market pull back, and use that as our entry. It's only a couple ticks above this larger 50%, but you're allowing the market to kind of show its hand and give you a little inclination that, okay, there's buyers coming in here, and this is a low risk opportunity to get into a trade. Then you can still use that negative 23% target of the 15-minute as as kind of a target or a shooting point, and then trail your stop the same way we do with any trade, and just trailing swing lows and just trail all the way up here for a really nice winner. That was a big, even though there may have not been a setup, a pullback on every single pullback, every single move down, like earlier in the day at about an hour after the bell, pull back to the 50. You don't get a pullback to the 50 every single time, but when you do, if you can just have a little bit of patience and let the trade work and trail your stop on the way up. I mean, here we have an 82 that took us up to 86. And so, a 4-point move in, 20 minutes or so, that's a pretty big, pretty decent move in the markets. Now I want to back up a little bit further to last Wednesday. And the reason I want to talk about Wednesday is we have this big, situation where we broke down below lows, and then we broke down below the 61.8, and then had this buying coming in to bring us back up into, above that 50%. And when we come down like this, and we're coming down lower, lower, breaking lows, and then we stop and start to move sideways. So here's the move down here, and then another leg down, and then all of a sudden we start to kind of develop some higher highs and higher lows, albeit small. When the very first sign of a trend change is a change or a break of a higher high or a higher low in the market, or a lower high and lower low in a downtrending market. And so we're looking for those trend changes. We've got this, little double top here, a break of the previous swing high. Well, that's not something we've seen on the move down. All we saw earlier in the morning was just lower highs and lower lows on the leg down. So once we start to identify that, okay, we're getting a little bit of a shift here, we can look at that as an opportunity to get into the first trade in the new trend. And so, even if the trade is a little bit dirty, meaning going back, you can see how the market traded below the 61.8. Using a 6-tick stop, just putting your order 1 tick in front of the 50, so a 57.25. Then you can see here, we only went down to 56s. So 6 ticks is really a great amount, a great stop size for the E-mini S&P. And you can keep it at 6 ticks, whether it's a volatile market, at least I do, a volatile market or a range-bound market. I keep things at 6 ticks, and you can see other times the market pulls back, and just by putting your order in front of the 50%, it may not touch it all the way, but if you put your order in front of the 50, sometimes you'll get it to touch exactly, or touch your order and get a fill without taking any heat on the trade. If we look a little bit further, we can see a larger 50% setup that also is what I call dirty, meaning it trades into the 61.8 a little bit, into the 50. But even putting your order, just even if you round it up on the trade, we only went down to a 57.25. So if you put your order at even 58.25, if you round it up and added a tick, you're still, you have some wiggle room. And it's important to be able to let the trade work. If you're entering the trade at the 50%, not moving your stop right away and tightening your stop as soon as you're 2 ticks, as soon as the market's 2 ticks in your favor, you got to give it some room to kind of move back and forth. In this case, we created this descending triangle, and then boom, we got that pop. So having patience at the start of the trade, letting it break the anchor's high for a long, and then start trailing your stop, trailing swing lows. And then, it's the market can start moving really quickly, and all of a sudden, you're moving your stop 2 points or 3 points, and you're locking in profit, or even a 3 or 4 point winner on the entire trade. That's a great move in the ES, and you just do that over and over again throughout the days, and then 6 ticks, essentially, that's your max loss per trade, so a 1.5. Well, if you're making 3 or 4 points on a winning trade, 1.5, no big deal to have a loser here and there. That is even 2 losers of a 1.5. Well, 1 winning trade of 3 points, boom, just made up for 2 losers. And that's kind of the that's the process you want to go through, in a thought process, when you're trying to develop a methodology. Okay, what's my win rate? What's my loss rate? What's my average winner? What's my average loser? And how can I craft a method around these numbers that will fit, to give me a profitability outcome? So lots of good stuff in today's video. If you want to join in the live trading room or get a copy of my trading rules for the month of November, I'm actually doing one-on-one coaching sessions as well. So you can get a coaching session and a copy of my trading rules over at eMiniMind.com/trading rules, trading-rules, or just click trading rules at the top of eMiniMind.com, and you can get everything there, as well as access to the live trading room on Tuesdays. So thanks for tuning in, and we'll have a great week. You have a great week in the markets this week. Have a great Thanksgiving, and we'll talk to everyone tomorrow morning.